Welcome back to the Gold IRA Blueprint podcast. We like to really dig deep into the world of gold and precious metals IRAs. And today, uh, today we're tackling a big one.
Yeah, a big one for a lot of people,
Absolutely.
for sure.
It's how to withdraw from your gold IRA the right way.
Mm,
We're always talking about, diversifying and protecting your wealth and all that. But
right.
what good is it if you can't actually, you know,
Access it.
access it exactly? So
Enjoy it in retirement. Yeah.
that's what this deep dive is all about. We're going to break down the strategies, the tax implications, the whole 9 yards.
Yeah, we're even going to touch on estate planning, how this all ties in.
Oh, yeah, that's right.
It's a big picture thing.
It is a big picture thing.
Yeah.
So let's jump right in. One thing that comes up a lot with retirement accounts in general are these
Yeah.
RMDs,
Required minimum distributions.
or required minimum distributions,
Yeah.
everybody's favorite topic.
Oh, yeah. The IRS loves those.
So for those that might not be familiar, can you give us a quick rundown of what RMDs are and how they apply to gold IRAs?
Sure. So basically, once you hit age 72, the government says, all right, it's time to start taking some money out of these retirement accounts,
Okay.
including your gold IRA.
So it's not like you can just let it sit there and
Right. You can just let it
keep growing.
keep growing forever.
Yeah.
They have a formula based on your account balance and life expectancy to determine how much you got to take out each year.
Gotcha. So it's not just like a free-for-all, take out what you want kind of thing.
No.
There's rules.
There are rules and there are penalties if you don't follow them.
Okay, speaking of penalties.
Yeah.
What happens if you, kind of miss the boat on those RMDs?
Well, the penalty is pretty steep. It's 50%
The 50%.
on the amount that you should have withdrawn.
Yeah.
So let's say your RMD was $10,000 and you didn't take it out.
Yeah.
You're looking at a $5,000 penalty.
Oof. That's a big chunk of change.
Yeah, you don't want to mess around with that.
No, you don't. So anyone listening who's thinking about a gold IRA,
Right.
keep those RMDs in mind.
Yeah, definitely be aware of them. And when you're choosing a gold IRA company,
Right.
make sure they can help you navigate all that.
That's a good point because
I'm sure
you don't want to be on your own trying to figure all that out.
Exactly. And they can make those withdrawals go smoothly.
Yeah. And speaking of choosing the right company, we always talk about that here on this show. And we do have a great resource for you guys.
Yes, we do.
It's our free checklist over at goldirablueprint.com/exclusive.
Very important.
It's packed with tips to help you select a company that fits your needs. Does all the things you need it to do.
Yeah. If you're feeling overwhelmed
Yeah.
by all the options out there, which most people are, that's a great place to start.
Absolutely. All right, so we've talked about RMDs, which, nobody loves those.
Right.
But we got to do what we got to do.
It's part of the game.
But what about when you want to take out more than the minimum? Or maybe you're not even at that RMD age yet.
Yeah.
What are the tax implications of just, regular withdrawals?
So just like traditional IRAs, withdrawals from your gold IRA are taxed as ordinary income.
Okay, so that means
So whatever your tax bracket is,
right.
that's what you're going to pay on that money.
So if you're in a high tax bracket during retirement, that could be
A big chunk.
a big chunk.
Yeah.
Which is why it's important to think about timing those withdrawals strategically.
Okay, so give us some strategies then. How do we work this to our advantage?
One way is to time your withdrawals for years when your income might be a little lower.
Okay.
So, if you anticipate being in a lower tax bracket during retirement, maybe hold off on those larger withdrawals.
Gotcha.
Until then.
So it's not just about how much you take out, it's about when you take it out too.
Exactly. And this is another area where a good financial advisor can be so valuable.
Right.
They can help you create a custom withdrawal plan to minimize your tax liability. Yeah, they know all the ins and outs, the loopholes, everything.
Exactly.
They can really help you out. So, all right, we've talked about taxes.
Uh-huh.
But let's talk about one of the big reasons people invest in gold in the first place.
Yeah.
It's the wealth preservation aspect,
Yeah.
especially, in times like these when things are a little uncertain.
Exactly. Gold has always been that safe haven asset.
So how does that factor into withdrawals?
Well, it's a key consideration because gold is known as a hedge against inflation
Right?
and market volatility. We've seen it play out historically, like during a stagflation of the 1970s.
Oh, yeah.
Gold prices soared over 2,300%.
2,300%.
Well, the stock market just stagnated.
Wow.
That's the power of gold as an inflation hedge.
That's incredible. I mean, for our listeners out there who are, maybe a little bit worried about inflation eating away at their savings.
Yeah.
How can they leverage that protective quality of gold when it comes to, actually taking money out?
By holding a portion of their retirement savings in gold, they're essentially creating a buffer against those market fluctuations and that eroding effect of inflation.
So it's like an insurance policy
Yeah, a good way to put it.
for your retirement.
Exactly. And when it comes to withdrawals, you can strategically liquidate small portions of your gold within the IRA, generate cash flow while maintaining that exposure to gold's long-term value.
So it's a balancing act,
Yeah.
keeping some in there for the long haul, but also
Got
taking some out when you need it.
Exactly. You don't want to sell all your gold at once, but, use it strategically to
Right.
weather those economic storms.
That's a really good point. Okay, so we've been talking about withdrawals, but I can't help but think about, the bigger picture here.
Yeah,
Estate planning.
right.
How do gold IRA withdrawals play into all of that?
Well, it's a crucial aspect to consider because gold IRAs, just like other assets, are subject to estate taxes.
Okay.
So it's not just about how much wealth you accumulate. It's how you manage those withdrawals to minimize the tax burden on your beneficiaries.
That's a good point.
Hmm.
So like, for example,
Right.
if you were to take out like a huge lump sum right before, something happened.
Exactly. Imagine taking a large lump sum withdrawal shortly before passing away that could significantly increase the estate tax burden on your heirs.
Yeah, that's something to think about.
Yeah.
So how can we minimize those estate taxes and, make sure the wealth transfer goes smoothly?
So one approach is to structure your withdrawal strategically to minimize taxes both during your lifetime and on the inheritance.
Okay.
This might involve taking smaller, more frequent withdrawals over time instead of one big lump sum.
Mm-hmm.
It could also involve something called in-kind distributions, which is a bit unique to assets like gold.
In-kind distributions.
Yeah.
Okay, tell me more about that. What is that and how does that work?
Sure. So imagine inheriting a collection of gold coins from a loved one. You wouldn't necessarily rush to sell them immediately, right?
No, you'd probably want to hold on to those.
Right. You might cherish them for their sentimental value and the tangible connection they represent. An in-kind distribution is similar. It allows you to take physical possession of the gold
Oh, wow.
rather than selling it for cash within the IRA.
So you could actually hold your retirement savings in your hand.
That's right.
That's pretty cool.
Yeah.
So when would that type of distribution make sense?
It's a good option for those who want to maintain direct control over their gold and potentially avoid capital gains taxes that might apply if the gold were sold within the IRA and then passed on as cash.
Okay.
Plus, you have the option to pass on those physical assets directly to your heirs,
Yeah.
which can be really meaningful for a lot of families.
Yeah, I can see that. So we've talked about, systematic withdrawals where you're taking out a certain amount, regularly.
Right.
And now these in-kind distributions where you're actually taking possession of the physical gold.
Uh-huh.
Are there any other withdrawal options for gold IRA holders?
Yes. There's also the option of taking a lump sum distribution where you withdraw all the funds from your gold IRA at once.
All right, so we've got like three main strategies here.
That's right.
Systematic withdrawals,
Uh,
in-kind distributions, and then lump sum withdrawals.
correct.
What are some of the things that we should be considering when we're trying to decide which approach to take?
There are several factors to weigh. We need to consider the tax implications of each method your liquidity needs, meaning how easily you can access your funds, and finally, those legacy considerations or how your choice will impact your heirs.
Okay, so taxes, liquidity, and legacy.
That's it.
Those are the big three
The big three.
when making these decisions.
Exactly. Each strategy has its own advantages and disadvantages.
Okay, well, before we dive into comparing these strategies head-to-head, let's take a quick break.
Sounds good.
And for those of you who are just getting started with your gold IRA journey and maybe feeling a little overwhelmed by all this information, don't forget to grab our free checklist at goldirablueprint.com/exclusive.
Yeah, it's a great resource.
It's filled with tips to help you choose the right company and get started on the right foot.
Absolutely.
We'll be right back to break down those withdrawal strategies in detail.
Okay, so let's dig into these different withdrawal strategies.
All right.
We've got systematic withdrawals, in-kind distributions, and lump sum withdrawals.
Yeah.
We're going to look at them through the lens of those three key factors. We talked about taxes, liquidity needs, and legacy considerations.
All right, sounds good. So to help me visualize all of this,
Right.
I know our source material actually has a table that breaks it all down.
Yeah, it's a great way to compare them side by side.
Yeah, I love a good visual.
Yeah.
So let's walk through that table.
Okay.
All right, so first up we've got systematic withdrawals.
Right?
What are some of the key takeaways when it comes to taxes with this method?
So the table highlights that with systematic withdrawals, those distributions are taxed as ordinary income.
Okay, so basically,
So you'll pay taxes on the amount you draw each year at your regular income tax rate.
just like your, regular retirement income.
Exactly.
We talked earlier about, maybe trying to time those withdrawals strategically
Right.
to minimize that tax burden. Does the table offer any other insights on that front?
Not specifically, but it does emphasize the importance of understanding your overall income and tax bracket.
Right.
When planning those withdrawals, working with a tax professional or a financial advisor can be incredibly helpful to create a plan that minimizes your tax liability.
Yeah, they're the experts.
Right. Exactly.
Okay, so taxes, we kind of got a handle on that. What about liquidity?
Right.
What does the table tell us about liquidity needs with systematic withdrawals?
Well, it indicates that systematic withdrawals require a relatively high level of liquidity,
Oh.
which makes sense because you're taking out money regularly, maybe monthly or quarterly,
Right.
to supplement your income.
So you need to have enough cash on hand.
Yeah, you got to make sure you have enough readily available cash to cover your expenses without having to sell your gold
Right.
at a potentially unfavorable time.
Yeah, you don't want to be forced to sell when the market's down or something like that.
Exactly. It's all about maintaining that flexibility and control over your assets.
That's a good point. So systematic withdrawals definitely require some careful planning,
Right.
to make sure you have that cash flow without depleting your gold at the wrong time.
Exactly.
Okay, so we've talked about taxes. We've talked about liquidity.
Uh-huh.
What about legacy? What does our handy table tell us about how systematic withdrawals might impact our estate?
It suggests that systematic withdrawals generally have a less significant impact on your estate
Okay,
compared to other methods because the funds are being distributed gradually over time.
so if minimizing estate taxes is a big concern,
Right.
this gradual approach could be a good way to go.
That's right. By spreading those distributions out over time, you're potentially reducing the overall tax burden on your beneficiaries down the line.
Gotcha. Okay, so we've covered systematic withdrawals.
Right.
Let's move on to in-kind distributions. What stands out to you about this strategy when you look at the table?
Well, the most striking thing is the tax implication. The table says there's no immediate tax on the transfer of the physical gold itself.
Oh, wow. So you're basically deferring those taxes.
Yeah, you're bypassing that immediate tax hit you'd get with a cash distribution.
So it's not like you're completely avoiding taxes,
Right.
but it does give you some flexibility there.
Exactly.
So what happens then when you eventually decide to sell that gold you've taken possession of?
At that point, you might incur capital gains taxes
Okay.
based on the difference between your purchase price and the selling price.
So something to keep in mind.
Yeah, it's important to factor in those potential future taxes when you're considering this method.
Okay, so we've looked at the tax implications. What about liquidity? The table says that in-kind distributions have low liquidity requirements.
Right.
Why is that?
Well, because with an in-kind distribution, you're not actually receiving cash. You're taking possession of the physical asset, the gold itself.
All right, so it's not like you can just, go out and spend it right away.
No, you need to be able to either store it securely or sell it
Right.
if you need that cash.
So it might not be the best option if you need access to cash right away,
Exactly.
but it does give you that, direct control over a tangible asset.
Right, and for a lot of people, that's appealing,
Yeah, that peace of mind.
that sense of security.
Exactly. Okay, let's talk about legacy, the last column in our table.
Okay.
What does it tell us about the legacy considerations for in-kind distributions?
Well, the table highlights a significant